Right now, Hyperliquid is quietly doing something that most Layer 1 networks cannot manage. The protocol is generating over $2 million in daily fees and using that cash flow to actively buy back and burn its own supply. We are looking at a fundamentally deflationary asset in a market built on infinite inflation. Yet, while prominent voices like Arthur Hayes are calling for a $150 price target, on-chain data shows he has been selling. That divergence between public narrative and actual blockchain data is exactly why we need to look closer. Today, we are breaking down the exact mathematical structure behind the Hype token. I'll show you why the recent breakout from a 3-week falling wedge pattern matters, and lay out my exact load zones and invalidation levels for the next 1 to 6 months. Let us establish the baseline. We are currently trading in the $30 to $32 range. Over the past month, the price action has been highly structural. In late January, we saw a massive 24% green candle break a multi-month descending trend line, which immediately triggered a 50% expansion from Breakout. That's the kind of momentum that forces the market to pay attention. But straight lines do not exist in trading. After that impulse, price consolidated into a 3-week falling wedge, trapping early buyers and testing the conviction of the market. As a position trader who has been navigating these cycles since 2020, I don't buy into emotion. I buy into defined risk. And right now, the risk-to-reward ratio on this particular setup is presenting a very specific opportunity. The token recently broke out of that falling wedge to the upside just 2 days ago. However, technicals without fundamental backing are just lines on a screen. There is an underlying structural shift happening with the network revenue that completely changes how we should view this technical breakout. The fundamental data actually dictates why this current support level is so critical for the broader macro structure. To understand the price action, you have to understand the cash flow. The data is entirely verifiable. Hyperliquid commands an undisputed 33% of the decentralized derivative market volume. Over the last year, that dominance translated into $760 million in revenue. And here's the critical distinction. 100% of those fees go strictly to the protocol. This is not an abstract valuation metric. On March 1st, the core team repurchased 48,000 tokens at an average price of $31. That is $1.5 million of buy pressure in a single day, entirely funded by real exchange revenues. Because of this continuous burn mechanism, the circulating supply of the token has officially dropped below 300 million. Exchange revenues are contributing to more burns than staking emissions and team unlocks combined. You're looking at an asset that mathematically becomes scarcer every single day. Furthermore, we are seeing real capital migration. Looking at the cross-chain data over the last 24 hours, Hyperliquid absorbed $25 million in net positive inflows from other networks. Capital is actively draining from competing Layer 1s and bridging over. A massive driver for this is uptime and accessibility. Traditional finance markets close down on weekends and during global conflicts, effectively paralyzing capital. Hyperliquid operates 24/7, enabling continuous price discovery on real-world assets when traditional legacy systems are offline. Even Hyperliquid's strategies is showing massive relative strength, standing alone as the only digital asset treasury in the green, holding $356 million in unrealized gains, while the rest of the market's treasuries sit underwater. But as investors, we have to manage our biases. For example, Arthur Hayes recently stated the Hype token could multiply 5 times from around $31 up to $150, calling this a price discovery phase. However, you always have to verify the blockchain. On-chain data shows he has actually sold some of his holdings previously. That means we have to protect our capital and let the chart dictate our entries, rather than buying blindly into the narrative. Now, let us look at the daily time frame. We are mapping our Fibonacci retracement anchored from the macro high of $59 back in September 2025, down to the multi-month base of $20 established across October and January. This gives us our mathematical framework. Right now, price is pinned precisely between the 236 Fibonacci level at $29 and the 382 level at $35. 2 days ago, we got the upside breakout from the 3-week falling wedge. That breakout is the trigger, but the moving averages tell the story of the trend. Currently, the price is holding above the 55 exponential moving average, the purple line, which acts as our dynamic short-term support. However, we are still trading below the 200 simple moving average, the green line. Until we reclaim that 200 moving average, the macro trend remains contested. Looking at the momentum, the Hyperliquid Relative Strength Index is sitting between neutral and overbought territory, but the trajectory is pointing strictly upward, indicating that buyers still have control of the immediate momentum. So, how am I trading this? My strategy here is a spot position, scaled for medium risk with a time horizon of 1 to 6 months. I'm focusing on capital preservation first. My primary load zone, the green box on my chart, is right here between $32 and $30. I want to accumulate as close to that 236 fib support as possible. My invalidation level is strictly defined. My stop loss is set at $24.50, marked by the red dashed line. But there is a crucial condition here. I'm only looking at the weekly candle close, which occurs on Sundays. Daily volatility can easily wick down and stop you out before reversing. If we get a confirmed weekly close below $24.50, the structural thesis is broken, and I'll cut the position. If that happens, I would look to reassess and potentially open a new trade near the previous absolute low around $20. But as long as we hold above that invalidation line, the upside targets are clear. Trading is just applied risk management. For this position, I'm employing a strict trailing stop system to protect capital as the trade develops. My initial take-profit targets, the green circles on the chart, are $35, $44, $60, and $83. If the price pushes up and hits that first target at $35, which is the 382 fib resistance, I'll immediately move my stop loss up to my break-even entry price. If we reach target 2 at $44, the 618 level, the stop loss moves up to target 1. This ensures that a winning trade never turns into a losing trade. You lock in yield and let the remaining position run risk-free. And a quick note on security. For the portions of my portfolio that I'm holding for the long term, I always secure my tokens completely offline in a hardware wallet. You have to remove counterparty risk from your deep holdings. So, we have a mathematically deflationary asset backed by massive real-world cash flow, currently breaking out of a highly defined technical wedge structure on the daily chart. I'm looking for accumulation in the low 30s, strictly protecting my downside with a weekly close stop loss. Remember, the data is objective, but the future is not. Let the market come to your levels and never force a trade. None of this is financial advice. This is simply how I interpret the market structure and manage my own portfolio. If you found this data-driven analysis valuable, hit the like button and subscribe to the channel. It really helps the algorithm. Also, I invite you to join my free Telegram group for faster, daily market updates and real-time chart setups. The link is right down in the pinned comment. Finally, if you want to see another protocol where the technicals and fundamentals are aligning perfectly right now, click the video on your screen to watch my latest deep dive on Chainlink. I'll see you over there.